Assalamualaikum and good evening to Mr. Shatir Daniel. Thank you for joining this discussion session. We are from accounting student in UNIZA. My name is Muhammad Nur Rafi and this is my groups.
My name is Fakir Raimi.
I'm Tasha.
My name is Farina. And my name is Shira.
Thank you very much all. We like to ask you about how your company operate and as well as focusing on the tax treatment for businesses. So Mr. Shatir Daniel, can you continue?
All right. Good evening, everyone. Thank you for inviting me to this discussion session. Our company operates in steel manufacturing and production. So today we will focus on the tax treatment of common business transaction and how current Malaysian tax rules and the 2026 budget proposals may affect us. Continue.
Thank you so much, Mr. Shatir Daniel. We would like to ask and to understand the company income stream, deductible expenses, and any tax compliance issue that especially relevant to the manufacturing businesses as such your company in steel production.
This is the right focus. In manufacturing, tax treatment can be complex because we deal with sales income, spread recovery, plant and machinery, logistics, staff benefits, and sometimes financing or rental arrangements. Please ask your question in order, and I will respond as fully as possible.
All right. Thank you. Hi again. If it is possible, could you explain the types of income that are taxable and income that are non-taxable for the steel manufacturing company?
Certainly, taxable income normally includes revenue from the sale of steel products by products, trade sales, service income related to fabrication of processing, and any another business receipt arising from operation. In contrast, non-taxable income may include capital receipts such as proceeds from the sale of a fixed asset where tax rules treat the gain under balancing charge or capital allowance adjustment rather than normal income and certain exempt income if specifically granted by law.
So it means that if we sell taxable scrap from the production process, it will be counted as taxable business income.
Yes, scrap sales are generally business income because they arise from the ordinary operation of a factory. However, disposal of plant and machinery is not treated like ordinary sales income. It is handled through capital allowance adjustment, including balancing allowance or balancing charge.
Okay, so next, for expenditure, what are the common operating expenditures in a steel manufacturing company and which items are deductible?
Typical operating expenditures include raw materials, wage and salaries, factory utilities, repair and maintenance, freight, insurance, security, professional fees, office supplies, and regulatory compliance costs. These are usually deductible if they are incurred wholly and exclusively in producing gross income and are not capital in nature.
So, would factory repairs be deductible immediately?
Routine repairs are generally deductible because they maintain existing assets, but an improvement that upgrades or extends the life of an asset may be capital in nature, so it would normally be claimed through capital allowance instead of an immediate deduction.
Next, I want to ask, how should the company treat entertainment expenses and lease payment?
Entertainment expenses require careful review because some are deductible and some are restricted depending on the purpose and recipient. Business entertainment, such as meals with customer or suppliers for genuine business purpose, may be deductible, while private or staff personal entertainment is generally not allowable unless a specific tax rule permits it.
And what about lease payment for equipment or premises?
These payments for factory premises or equipment are generally deductible as operating expenses if they are revenue in nature and used for business. But if the arrangement is a hire purchase or finance lease with ownership transfer features, the tax treatment may shift, and the company may instead need to consider capital allowance on the underlying asset.
Okay, so Mr. Shatir, we're wondering about how is depreciation treated for the tax purposes.
Accounting depreciation is not taxable for tax purposes. Instead, the tax system allows capital allowance for qualifying expenditure for plant, machinery, and certain other assets. Therefore, when we prepare tax computations, we add back accounting depreciation and replace it with the relevant capital allowance claim.
Oh, so the company must maintain both accounting records and tax schedules.
Exactly. The accounting record shows depreciation for financial reporting, while tax schedule track capital allowance claims, written down values, disposal, and balancing adjustment.
Next
All right.
question, Mr. Shatin. Can the company claim deduction for donation and business zakat?
Yes, but the treatment differs. Approved donations to permitted institution may be deductible if they meet statutory conditions, while business zakat paid by a company is generally deductible subject to the applicable tax rules and documentation. The company will always retain receipts, official acknowledgements, and evidence that the payment qualifies under tax law.
I see. So the key issue is whether the donation is approved and whether the zakat is paid for business purpose, right?
Correct. The company must ensure that the donation is to an approved recipient and that zakat is properly supported and recorded as a business expense for tax purposes.
Um, at least bit of that bad debt, and also show how an aging schedule of receivable actually helps.
A bad debt is a receivable that becomes irrecoverable and may be deductible if it meets the legal condition and has been written off in the account. A provision for bad debt, however, is usually not deductible because it is only an estimate. Tax deductions normally require evidence that the debt is actually bad and written off.
Okay, so for the expenses, right? What expenses are entitled to double deduction for a manufacturing business?
They provide public deduction for certain qualifying expenses to encourage specific activities for a steel manufacturing company. Relevant examples may include approved research and development, export promotion activities, training under approved schemes, and certain environmental or innovation-related expenditures if they meet the condition. The exact eligibility depends on the nature of the expense approved status, and supporting documentation.
Okay, so this company cannot assume all training or promotional costs qualify automatically.
That is correct. The company must check whether the expense is specifically covered by the tax incentive, whether it is approved by the authorities, and whether the claim period is still valid.
Next, can you explain about the capital allowance, treatment for plant and machinery, including balancing allowance and balancing charge?
Yes, of course. For plant and machinery, tax relief is given through capital allowance rather than discretionary. The general rates for qualifying plant and machinery are commonly 20% initial allowance and 14% annual allowance, while heavy machinery general attracts 20% initial allowance and 20% annual allowance. For certain budget 2026, qualifying capital expenditure accelerated capital allowance of 20% initial allowance and 40% annual allowance is proposed for heavy machinery from local manufacturers, plant and general machinery from local manufacturers, ICT equipment and software and related software development.
All right, Mr. Shatir, you look so exhausted to keep answering our questions. So this is our last questions for you. And when we talk about 2026 budget incentive, the question is what's relevant tax relief or incentive from the 2026 budget should your company consider?
Several items are relevant to a steel manufacturer. First, the accelerated capital allowance proposal for qualifying capital expenditure incurred from 11 October 2035 to 31 December 2026 may be useful if the company qualifying capital eligible machinery, ICT equipment, or software. Second, the 2026 budget confirmed that the carbon tax will be introduced starting with the iron, steel, and energy sectors, so the company should monitor compliance and cost impact closely. Alright? The budget extends from foreign source income exemption and includes other business incentives, but the most operationally relevant items for a steel producer are capital investment support and carbon tax.
Okay, so that means the company should plan investment within the incentive window.
Yes, timing matters because
Hmm.
foreign capital expenditure must fall within the stated period and meet the local manufacturer or other eligibility conditions. Strategic planning of machinery purchases and IT upgrades can naturally improve the company's tax position.
Okay.
That's all for us actually. Thank you again for Mr. Shatir Daniel. I
Thank
think this
you.
discussion helped us understand how tax rule apply to a steel manufacturing company in the practical terms. We are now maybe have a clear basis for preparing our report and in the video recording. Thank you a lot for your times and guidance. We really appreciate all the opportunity to learn from this discussion. Thank you, Mr. Shatter.
You're
Thank you,
welcome.
Mr. Shatir.
For you.
Alright, thank you.
Thank you. Thank you.
Thank you so much.